The talk was very informative. It actually introduced all the main concepts, CVA, KVA, FVA. I will tell you about a slightly different approach, which is based on brute force. Brute force is underrated these days, but it's very useful. This is the result of a decade of work. We have been building systems for portfolio simulation based on large memory servers with acceleration. Meaning, instead of having big rooms full of grids with a lot of small computers as powerful as my notebook, but except you've got thousands of them, all wired to do this kind of calculations. We have one big, large memory server with terabytes worth of memory and acceleration and all that. The advantage of doing this is that we can have a holistic view on the portfolio. So as opposed to having to take the portfolio, split it off in many sub-portfolios, and then let the simulation in a way communicate through the wires, the interactions between the instruments. You have them all in one single box. So everything is holistic, and you can look at the portfolio in its entirety. So this way, you just don't have to play tricks. We never use adjoint differentiation. We never use Long-Schwarz. We never use American Monte Carlo. All of these toolkits, in our case, are not used. We just use brute force. But of course, brute force has to be based on a suitable type of mathematics. I mean, we are using operator methods to reformulate, recast the formalism of mathematical finance in such a way that when we then deploy it on this kind of memories, large memory servers, we end up with applications that are compute bound, meaning where you don't spend an excessive amount of time moving information through the wires or through the memory buses, but most of the time is actually spent doing actually real work. That's why you end up needing much less hardware. Hardware is much lower cost than otherwise because you're simply using it better. Now, some of the things we do are in a way are new and original. I mean, we typically you simulate only market risk factors. We also simulate all the credit risk factors. I mean, in these kind of portfolios, you have credit risk factors. So for each and every one of the counterparties, you have a series curve. Typically, these credit risk factors are not simulated because they are 10 times as many as the market risk factors. We simulate them all. Instead of focusing on aggregation that is done on a net inset by net inset basis, we aggregate at the portfolio level. So the metrics we look at are holistic at the portfolio level. It takes no additional time to have these holistic metrics. We run more scenarios than usual. I mean, in a typical implementation, we run about 1,000 to 5,000 scenarios. We easily run 1 billion scenarios. Meaning all the mathematics that has been developed, especially in recent times, to avoid nested simulations is just not used. We do nested simulations. We can have 20,000 primary scenarios, and every year we branch off 1,000. We not only compute capital, we simulate capital. Brute force. So mathematics is going to be much simpler, very simple. Just a couple of formulas, and I'll show you in a moment. Finally, in addition to this, we also give up to all analytics observability. You know, everything you learned about stochastic calculus, take it right away. Any two-factor Markov chain model will work. Anything. You invent a new interest rate model today, tomorrow it's in the system. Brute force. Again, is the key word here. Now, let's go through all these XVAs. Starting from the FVA. FVA is the cost of funding variation margin. And I've been publishing papers on this topic. The key point we make is that the FVA should be computed from the point of view of the portfolio as a whole, and not, the calculation should not be split off from across net insets. If you do that, you end up with a number for a capital deduction, which is vastly different from what you obtain with a net inset by net inset approach. Tell you about the theory. How does variation margin work? Well, basically you receive variation margin, and this variation margin comes from those trades whose hedge is a receivable, right? And you receive this variation margin, and the variation margin you receive can be rehypothecated against those hedges which are payable. But in addition to doing that, when you compute variation margin, you also need to account for the fact that if you have capital, shareholder capital, fees, whatever makes up your capital, you can take your capital and at no cost, you can turn it into variation margin. Let's say you have a bond, €1 million worth of bond, and you reverse repo, you get the cash, you apply the cash to a hedge, the cash leaves your portfolio, your capital comes down by one notch, by 1 million. However, if you do that, the hedge appreciates by 1 million. So at the end, you don't lose any capital. Meaning capital and funding are totally fungible, as far as variation margin is concerned. Initial margin is a totally different story. Initial margin is an inefficiency in the system. Variation margin is not. Initial margin involves assets you hold in a custodian account, you post them. When what you receive back is only an initial margin receivable, which is highly liquid, so that's not part of your capital. So you want to borrow entirely your initial margin. For variation margin, instead, you can use your capital at no cost. Because of that, when projecting out the cost for variation margin, it's important to project out the cost of capital. Finally, CVA and FVA fees, which are received from clients, are also in a pot that can also be used fungibly to post variation margin. And that's why here the problem is a bit circuitous, because you need to figure out what's the FVA, accounting for the fact that you charge the FVA and you can post that variation margin. So it's a bit circuitous, but I'll show you in a moment how that works. But the conclusion of all this is that in order to look at how all of this capital can be used for the purpose of posting variation margin, you need to have a holistic approach to your book. And because it's only the remainder, it's only that collateral which is not in this pot, which needs to be procured on a short-term unsecured basis and posted. But to do that, to arrive to this point, what you need to do is again to model the full credit cycle. So a full credit market simulation is required. And you need to value this funding requirements in a holistic basis, just on the portfolio level. To do that, we do a nested simulation, no fear. 20,000 primary scenarios every year on 100 time points, and then every year we branch off and we launch another 1,000. And as we launch another 1,000, we recompute every year in the future what's your CVA, what your FVA is going to be. And we end up with these three equations. These are going to be the only equations in my presentation. There's three elements here. We basically are looking at understanding the capital structure of a bank. So we have the liability side and we have the equity side. The debt side is the FVA and the equity side is the KVA. So two parts of the same set of equations. But the first equation is economic capital. As Moise was explaining, economic capital, or regulatory capital, is there to cover exceptional losses. What does that mean? Well, that means it's there to cover losses that you cannot hedge. People are coming, in banking, are coming to the conclusion these days that markets are incomplete. You cannot hedge everything. You need the capital. And so how do you deal with that? I mean, it's a big change. It's a big change. In incomplete markets, academics teach us that you need to do expected utility valuation, that agents exchange utilities. If markets are complete, the story is different. The story is the Black-Scholes story, very, very simple. You do it transaction by transaction. It's transaction, it's a value. I mean, it's a discounted expectation of future payoffs. You can price a transaction in isolation in complete markets. And then the total value is the sum of the values. Here the story is different. If you are in the Black-Scholes world, if you want to do portfolio optimization, how do you do? Well, you try to rack a profit on each one of the transactions. Whatever profit you make on a fair valuation basis, you immediately distribute it to your shareholders or to your bonus pool. And then you go on to another transaction, then another transaction. Instead, nowadays, capital is important, meaning the interaction between all the trades is important. And that means you need to do portfolio optimization. Why? Because, in a way, we have departed from this Black-Scholes world, and now we are exchanging utilities. Now banks are exchanging expected utilities. So we are in this new, brave new world, where we went back to the 50s and decided that, after all, there was something wrong with the perfect market hypothesis, and the mathematics has to adjust to that. So how does it do it? Well, capital becomes important. Now, what I have there as my first equation is an equation for economic capital. Now, regulators have come up with a large number of different charges, regulatory charges under Pillar 1. Each and every one of them attempts to capture some element of economic capital, which is a Pillar 2 concept. This Pillar 2 concept basically is expected shortfall with 97.5% confidence, according to the new IFRTB. So that's what I'm using. I'm looking at the 97.5% quantile and taking expected shortfall on that basis. That defines my economic capital. But in this equation, what I'm doing is to look at economic capital not only at current time, but also in the future. It's essential to project out economic capital in the future. And I'm doing it, without any linearization. The problem is fully nonlinear. I'm doing the equivalent of full rival VAR at present and in the future. For the entire book, and here a book, the case study I'm presenting has 2,000 counterparties, 100,000 trades, but a portfolio here can be up to 1 million trades and 10,000 counterparties, and the technology has to be able to support this kind of calculation up to that scale. And it does. Okay, so ECT is the projection of economic capital in the future. And then we have these other two equations. One is for FVA and the other for KVA. So the FVA gives the cost of funding. As I explained, the cost of funding has several elements here. Well, one is the sum over netting sets of the valuations, minus whatever comes from the CSA thresholds. Here I'm taking the algebraic sum, because whatever collateral I receive, right, can also be posted. So what matters is the net. But the net that I obtain after looking at the rehypothecation also has to take into account of the other terms which are given by capital. Also capital can be posted as variation margin. And the CVA and the FVA fees also make up buckets that can be posted. Out of that, one makes up this FVA number, which is just a discounted expectation of whatever is the residual. In case this residual is positive, because if it is positive, it needs to be funded. If it's negative, well, this means there is excess cash, excess capital in the book. Well, fine. It's worth OIS. It's worthless, basically. The other equation that I have here is the KVA. The KVA here is a funny number. It's an exponentially weighted average of economic capital, where the exponentially weighted rate is the hurdle rate, is the H. The same H that more as H. But I'm defining it here using Pillar 2 economic capital, not Pillar 1. We could also use Pillar 1, but my choice here is to do a Pillar 2 calculation. The FCA-FBA approximation to the calculation of FVA involves looking at this formula for FVA and simplifying it a bit. Well, firstly, you get rid of economic capital. And you get rid of the CVA and the FVA fees. You get rid of all that. Because to compute those, you need a nice simulation. So you get rid of those. And, well, but if you get rid of those, I mean, you get rid of a large chunk of collateral that you could use for variation margin, right? So you need to adjust also the spread here. What is the spread, the funding spread? Well, you would say it's the cost of borrowing on an unsecured basis, right? Whatever the market cost is. Yes, but if you neglect capital, the cost has to be normalized, has to be reduced. What treasuries are doing nowadays is to say, well, I'm not going to do my calculation for FVA using the cost of borrowing, the actual cost of borrowing. I'm going to use a blended curve, which has a much lower spread, because I'm forgetting all of these terms. This is a bit tricky. This is a tricky thing that regulators don't like, because a blended curve, is subject to a lot of judgment. I mean, it would be much easier to do the rigorous calculation. I mean, blended curves are something that regulators are increasingly frowning upon. But that's what people are using, otherwise the number that comes up is absolutely out of bounds. Totally unrealistic. I'll tell you in a moment more of a story about the numbers. The other thing what people do is to eliminate this plus here. See this plus here? This says, well, if you have excess cash, then actually there is a benefit. I mean, if you have a deficit, you need to fund it. Okay, that's a cost. But what about if you have excess cash in your book? Well, let's say it's let's say this doesn't happen. Let's say that, banks typically only have receivables on the unsecured side, because if a client has a payable, typically they want to, they have a receivable for the client, a payable for the bank. The client will want to restructure it. They will want to have money up front and then restructure it. So the bank ends up having mostly receivables. And so this number here is largely positive. This sum here is largely positive. Likelihood it's negative is very small. So let's take this plus here and let's get rid of it. Benefit of that is that then this becomes linear. Well, nice. I mean, if it's linear, then we have our big grid. We can linearize over, if one node does one netting set, another node, another netting set, we are in linear space. We can distribute the calculation. So the key to distribute the calculation is to ignore capital modeling, ignore the possibility that books can be payable, and use a blended curve. Now, this is problematic, though. As I said, blended curves, well, they are made up by treasuries, but can you market books with a blended curve? And this plus here, if you take away this plus, what you are implying is that if you have excess cash in your portfolio, actually that earns a funding rate. Well, that introduces two prices for the same assets. Because cash earns OIS on a riskless basis. If you assume that it earns funding rate, you're in trouble. I mean, the whole mathematical formalism breaks down, the whole of it. And you arrive to paradoxes. In particular, you arrive to concluding that the benefit side, right, the funding benefit out of those netting sets from which you receive cash is actually non-zero. And this portion is captured by this term here, the FBA. Rigorously speaking, if you believe in the law of one price, the only value for FBA that is acceptable is 0. If you don't, you're in trouble, because then the FBA as a formula looks very much like the DVA. Then accountants get worried. Oh wow, there is an overlap. Then we cannot recognize FBA as a benefit to capital. You're welcome to put it in valuations, but not to capital. Take it away from capital. So what capital is left with is only an FCA deduction, only a deduction from the positive side, meaning you end up ignoring rehypothecation. And that's problematic, because rehypothecation cuts down your costs a lot. I mean, it's actually something that can definitely be monetized by managers, but cannot be recognized in capital. Why? Because the mathematics is broken. Because of the need to distribute the calculation, you broke the mathematics down. In addition to that, this problem is particularly interesting because, and worrisome, because now regulators are looking into having an FVA VAR type of charge. I mean, see if the FVA must be a tier 1 capital deduction. Well, of course, there has to be also some regulatory charge based on the fact that this capital deduction is volatile, it's a function of time. And we have seen during the crisis that CDS spreads skyrocketed. So this FVA VAR should account for that, should account for the potential that the spreads of banks will go up. But here it's problematic because this FVA VAR is computed on a broken model. Now let's see what the numbers turn out to be. If you only included the FCA as a tier 1 capital deduction, in this case study example I have, which has a CVA at 276, the FCA is 337. Using the CDS spread of the bank to compute it, okay? Not using a blended curve like most banks do. I'm just using the CDS spread of the bank, which is what regulators would like people to do. They would like them to reflect into account their real cost of funding. So that's what I'm doing. If you use a blended curve, take this number divided by 4, and you can make it smaller, more realistic, but regulators may not like it. Anyway, we start with 337 here. If instead of aggregating at the net inset level, we aggregate at the fund inset level, instead we have a much smaller number. We have 149. All I did here is to change the level of aggregation. As opposed to using distributed computing and aggregating on a net inset basis, ending up with an FBA that then I have to trash because it's not an acceptable benefit. I'm aggregating at the portfolio level. My FBA at the portfolio level turns out to be 0 anyway, so whether I neglect it or not makes no difference. And at the portfolio level, I left a much smaller number, which is 149. That's progress. Further progress if it's instead of just looking at the hypothecation, I also include the other terms in my equation, and I start accounting for economic capital and the CVA VA fees. That's a substantial part of capital that reduces further the FVA to a 60. That's a big reduction. We go from 337 of an approximate calculation to 60 for a fully rigorous calculation. The difference is that you need to run 1 billion scenarios and global aggregation. But still, this 60 is totally defendable and totally rigorous. And it's based on the CDS spread of the bank. It's not based on a blended curve.